Joining me now is Cornelia Meyer. Cornelia, thank you so much for joining me. Cornelia, of course, is the chairman of MRL Corporation in London. Thank you so much. Cornelia, you've been watching this market for a long time, like myself here, but this has been a very challenging year and a very different year in many ways. What's your take on it?
Well, it's been a very challenging year because there's such an oversupply of oil in the market that the price was so low. And last year, yes, it was low at the end of the year, but overall during the year it was about between $90 and $100 averaged. This year it was averaged out around $50, which for a lot of countries is a problem because they have to balance their budgets, and especially the countries with weak balance of payments, like Nigeria, like Venezuela, like Iran. They found it incredibly challenging. The Gulf countries found it challenging, but they have a lot of reserves built up. And they can go for a long time at those prices because they also have debt capacity. So far, they have not really had to raise debt. So the Gulf countries, the GCCs, the Saudis, the Kuwaitis, the Qataris, they are fine.
Now, when we look at the market, I mean, we've had sustained oversupply on the market for way too long, as many people might say. We're seeing some reduction in American oil on the market here, but probably not as much as really the ministers would have wanted to see, and not so much as OPEC would have wanted to see. It's a tough situation at the moment, but there's a sense of stability, I suppose, coming into the market. And, is this really what they have to be grateful for at the moment? Some sense of stability?
Yeah, I think so. And shale was really the big surprise. We all expected that with the lower oil price, more companies would fall out because it's relatively high cost of production, but they were more resilient and they increased productivity. I think that we see more stability. If I look over on the end of 2016, we'll probably see a rise. Well, have a look at 2017, we'll probably see quite a big rise in oil price because we've seen projects worth about $200 billion cancelled. That's 20% of the capex of the big oil companies. At some stage, that will be less production working its way into supply.
When we look at that decrease in investment, I mean, this is something we've heard from the Secretary General of OPEC. We've also heard the Saudi oil minister talk about this just this week too, the need for sustained investment, even at a time of low oil prices. What is the big fallout in terms of the lack of investment?
Well, it's an ultra long cycle business. So if I in conventional oil invest $1 today, I will produce in 3 to 10 years. So in 3 to 10 years, we will have not enough production. We will have still a lot of demand. Don't forget there are hundreds of millions of people who've been lifted out of poverty in China and India. They all want to drive cars. These will be gasoline cars. So there will be sustained demand, and we won't be able to produce it. We won't be able to produce it quickly. This is not a light switch business. This is not something where I can say, well, I now want to just up the production. It's an ultra long cycle business. It will then take 3 to 10 years until you can produce.
And of course, the danger is we're losing a lot of people in the industry. This is also something that really everybody needs to be concerned about.
Yeah, we need to be very concerned about. And we don't forget also that the shale industry in the US had some problems, and these people are moving on. People are moving on to different industries, and they may not come back. And we've had for a long time sustained lack of people.
Now, we've just seen the Venezuelan minister join us there. Again, Venezuela, a country that needs a lot of investment, not happy with the lower oil price. And when they look at what's going on in the market there, the market there has been lacking investment for several years. So this is not new just because of the low oil price there. Really, that's an industry that really needs more attention in Venezuela.
Yeah, Venezuela needs a lot of attention. But as you rightly pointed out, it is not just about the low oil price and lack of attention. They also need to have better investment policies so that big oil companies feel comfortable putting their money there for the next 20, 30 years.
And again, we look at the supply, we look at the demand that's around in the market. OPEC and indeed IEA has also said that we're looking at an increase in demand next year, not as buoyant as it was before. We're certainly looking at an increase of over 1 million barrels a day. But again, this is not really enough to pull in the surplus oil, really, is it? I mean,
Yeah, no, it's not enough. We are producing on average about 1 million barrels a day too much. But in the long run, we will have more people. Again, these middle classes in India, the middle classes in China want cars.
When we look at what's going on in Africa as well, that's a growth potential region here. The Angolan minister has just passed by here now, but also other countries in Africa that were looking at the oil market, looking with a little more, like countries like Uganda, like Ghana. A lot of projects, again, in Africa have been shelved at the moment because really at these prices, the investment is just not there.
Yeah, absolutely. And a lot of these investments in Africa are ultra-deep water investments off the coast of Angola, off the coast of Nigeria, and they're incredibly expensive. So you need a certain higher oil price to justify an investment in such an expensive project.
When we look at other economic activities that are impacting what's going on, and there's an awful lot going on this week. It's probably one of the busiest weeks in terms of news coverage where we're competing, really. We've had the ECB decision. We have Janet Yellen saying she's looking forward, to the rate hike in the US. We've also got the Paris talks. Let's just look on the economic side in terms of the ECB and the Fed. What's going on there?
Well, that's very interesting because Draghi is going out full steam with quantitative easing. And he's very much, whereas Yellen is putting up the interest rate, so the dollar will become more expensive, relatively. An expensive dollar means usually lower oil prices because oil is always inversely correlated to the dollar.
And again, but what is the fallout? What will happen in terms of like what's going on between Europe and the US? I mean, it's kind of not quite currency wars, but it's not looking good out there.
It's not looking good, and it is sort of a currency war because the euro will be so cheap, which will be very bad for US exports. It will be great for European exports, and let's not forget, especially Germany and the US, a lot of the things they produce the same things, just with different companies and different technologies.
When we look at the US economy, we've seen some good figures, but really looking into next year, the economy really doesn't have a great trajectory on the upside in terms of wonderful results that are coming out. And people are actually very concerned about what's going to happen to the American economy last year.
I would be very concerned too, because if the rates go up and the dollar goes high, there's a lot of money will come out from emerging markets into the US. That's fine, but those emerging markets won't have the money to purchase the US goods. So it will be very, very bad for US exports.
When we look at American demand on the product side, refinery activity is going at almost 95% at the moment. So they're still driving in America, and there's huge demand on the product side. But that doesn't necessarily turn into crude. And the stockpiles, are just overloaded at the moment.
Well, stockpiles are overloaded, but let's not forget, the lower the oil price, the more the Americans will drive. It's a driving society. Expect everybody to go and see their family over Christmas by car now because it's just so affordable.
I was listening to a news report actually this morning saying that in China, though, almost the opposite is happening, that the car dealers are having a hard time actually selling cars. So there's been a bit of a pullback in China. But again, everyone looking to the Chinese economy to really save the day. But it's quietening a bit and it is really softening. But again, would you say that, there's still potential in the Chinese market? Or, are they overreacting, do you think, sometimes?
Yeah, they're overreacting because what we'll see is in China, they're moving away from only being an investment-led and export-led economy into a domestic consumption-led economy. That will have to work its way through. And we will probably see less BMWs being sold and more smaller cars because these young people, these new middle-class people, they want the car, and that will be a gasoline car. So it's bad news probably for BMW and for Volkswagen, but it's great news for small Korean cars and small Chinese cars.
And ultimately, it's almost quantity, maybe not so much quality, but again, that does, look good enough for oil demand when it looks. Again, it's probably slower increase than we were expected, but at the same time, there is going to be some increase out there in demand.
Yeah, it's a slower increase and it's a different increase. It's less the increase going into the big projects and again, the big cars. It's more the increase going into the smaller cars. So it's again, these changes take time to readjust. So I'm not worried. I'm not worried that we don't need gasoline. I think we will see much less demand for diesel and we'll see much more global demand for gasoline.
When we look at the situation in Iran at the moment, and we're waiting in terms of dates for the first round of sanctions, right now, I mean, it is a bit of a waiting game, but it really does look like the Iranians are getting ready to actually put some investment. And again, the deals are maybe not being done as we speak, but certainly they're being considered and the conversations are being had. I mean, Iran looks like it's going to be a good investment play for many of the big oil companies, in the years to come, in the months probably to come.
Well, Iran is going to be a great play for oil companies, and it's also going to be a great play for other companies, because don't forget, it also has a great industrial sector. But I would be very cautious in saying they're going to go up and have another 1 million barrels a day producing very quickly, because it's a heavily underinvested sector. They need to first put the investment in there to be able to really crank it up. And let's not forget, when you look at a country like Saudi Arabia, when they increased their production capability by 1 million barrels a day, took them a long time, and they have a great oil company which is functioning, access to capital markets, and it took them a long time. So with Iran, where we have more challenges, it will take them longer. So I think people are a little bit overly optimistic in thinking there will be 1 million barrels a day. Also, 1 million barrels a day is about a quarter of the Iranian capacity. Upping any capacity of any industry by a quarter is a challenging thing to do.
And of course, that oil that will come from the Iranian market too will probably mainly find a home perhaps in Asia. It's not really going to compete with the Americas of the world, and really in Europe. We're still seeing demand in Europe quite sluggish. But there will be a home for that, as Asia and the region there picks up.
But look, what happened over the last 10 years or so, we've really seen the center of gravity of the economy shift from the west to the east, from OECD to the emerging Asian economies. So yes, that is where it is. And when you look at what happened to OPEC oil, a lot of the OPEC oil is no longer going to America. Still a lot is going to Europe. But a lot of it is going to China, and a lot more will also go to India when all these Indians start driving these small cars.
Talk to me about OECD demand, because it hasn't really been wonderful in the past few years. It probably will never become wonderful again. It won't be the driver in terms of global oil demand. But OECD demand, particularly Europe, has actually been very soft in recent years. Do you see that continuing?
Yes, I see it continuing. And we've seen a decarbonization of now we're coming to the Paris talks, right? A decarbonization of the OECD economies with much better measures for demand side management, with just so much emphasis on how much CO2 you use, very big time into electric cars, which is quite funny because a lot of the electricity is then produced by coal-fired power plants, but that's another matter. So that is really what's happening. But this decarbonization of the OECD economies, other than the US will always remain a driving economy, is quite interesting.
Interesting and absolutely essential. I mean, it is something, there's a lot of public pressure there, there's a lot of government policy been put in place, and really we're beginning to see a lot more buy-in from the big oil companies, cleaner fuel, and really building in efficiency. Have you noticed that in the last year, and maybe a shift actually towards, really being part of the solution?
Oh, absolutely. And I think the oil companies have always been looking at it, but right now it's just politically no longer acceptable. Look at what's going on in COP21. You have America, you had President Obama very strongly voicing for it. You have the Chinese who in this new 5-year plan, really the decarbonization of the economy is right on the top of what they're looking at. So most countries, OECD, non-OECD, really are worried about CO2 emissions.
Whatever comes out of Paris, and I mean, people are a bit nervous there at the moment in terms of what will come out and what they need to put in to what they get out of there. These are still really non-binding agreements, are they? I mean, what can be done about this? And will it be the sentiment that will actually move the decarbonisation of the oil industry and just the general economy?
I think it is very much so. And you look at it in Paris, it is you have great consensus, but the proof of the pudding is always in the eating. So you can promise anything unless it's enforceable, and Paris will not be enforceable. People can promise and not everybody will deliver.
When we look at where now the UAE minister, in fact, no, Qatar is just joining us here. Again, a huge power play in the industry too. Talk to us a little bit about Qatar, where they're really looking at the gas market as well.
Yeah, Qatar is very important for the gas market, and it's very important. It is the LNG player, bar none. So Qatar is very interested what will happen to LNG, but it's good news for LNG with when you look at Japan, which is going away off nuclear. They will need more LNG. China China, which will want more gas for its electricity production, will want more LNG. So again, the big LNG markets will really be not Europe, not the US. It will be China. It will be Japan. It will be Korea.
Talk to me again about the state of the Middle East markets. You mentioned it there in terms of the reserves that they have in place, the investment that's in place. The big Abu Dhabi International Oil Conference just finished a few weeks ago. Secretary General was there. Huge attendance, and the minister actually committed that projects are still going ahead. Is that region, in your estimation, a region that they're still putting some investment into? They have to do some of these big government projects. So talk to me about that.
Yeah, no, absolutely. They have to do a lot of these projects, and we all, the world, should thank those countries for doing them, because we do need investment. When the big Western oil companies have underinvested, and we have demand, we have to get the oil from somewhere. And you have seen that Saudi Aramco is one of the companies always investing, no matter what happens. As is the case in Abu Dhabi, the Qataris are good at it. The GCC part of OPEC really delivers. Where the oil prices are low, they're high, they invest, they deliver. We can count on them.
And again, they're in a position where they can, manage, perhaps not necessarily afford, but they can manage at these low prices. They have invested well, they've got good, strong sovereign funds, and this is actually helping them do it. But there is a commitment very much to, I guess, the bigger social picture, to their people really, as well as to everybody else.
Well, there's a big commitment to their people, and yes, the budgets are stretched, and a lot of them are now running deficits, but they have a lot of foreign reserves. As I said before, they have a lot of debt capacity. They basically haven't borrowed. Look at the Japans, the US, the Europeans, they're so over-levered. So they have debt capacity, that's one thing, and also they have other macroeconomic measures that they will have to put in place. Low oil prices are generally good for macroeconomic prudence in those countries.
And again, we're looking at, a group of countries there, but they've also got, a big wide neighborhood there that's going to become a big consumer market, whether we like it or not. Yes, producing market, but, really about to become a huge consumer market.
I think that's absolutely right. And if you look at GCC, they very soon they will consume a lot of what they produce. So that's a very important thing.
Now, the Libyan minister has just passed, and unfortunately, a situation there where they're just underproducing. A sad situation. That will be resolved, hopefully, eventually. But that's taken a lot of oil off the market. When that does get resolved, that's going to need huge infrastructure build and huge investment again, won't it?
Yes, it will. But, at this point, Libya does face a lot of challenges. So we need to, first, the political things need to be sorted out before you get big companies putting a lot of money there. And let's not forget, Libya has always been about 3% of global oil production. So it's not that or less, actually, 3 million barrels a day. So it's never been that high an oil producer. It's been, for Libya, very big, for Europe, very big, because European refineries just love that sweet, low-sulfur crude from Libya.
Now, talk to me about some of the non-OPEC players. Let's take a look at what's going on in Russia. The latest figures that I saw there, 11 million barrels a day being produced, and it's up on last year too. But again, Russia is being involved in the conversation. At least they're all talking. They might not be doing much about it, but the OPEC non-OPEC conversation has certainly been had.
Yeah, the OPEC non-OPEC conversation is being had. It's difficult. Russia is in a little bit of a difficult spot because unlike the GCC countries, they don't have these. They have reserves, but not that many reserves. They're also dealing with aging population and what comes out from there. So they do need to produce to keep people warm in the winter, which is why they may not be too happy to go along and say, okay, if OPEC cuts production, we'll cut production too. I don't think that will happen at the current oil prices.
But also, when we look at the situation in Russia, I mean, there's, yes, a lot of government support and government control, but again, there's, many big private players there, as is the case in many of the non-OPEC countries. So therefore, it's not as if the government can actually say, we have to cut and that will happen. It's not that easy, is it?
Absolutely, it's not that easy. But in the case of Russia, Rosneft, which is majority owned by Russia, we just gobbled up Yukos and has just bought the TNK BP thing. So they are the predominant producers. So yes, Russia could actually, but obviously Rosneft will say, if we cut, then the private guys need to cut too, and the private guys will say, nice thinking. So it is difficult, you're right.
And again, when we look back on the challenges of the year, I mean, that has probably been one of the toughest ones in terms of like just bringing everybody to the table and making everybody see, really, focus on the same goal, I suppose.
I think so, yes. And when you look, I have some sympathy for the GCC producers who said we need to keep the production up because the others need to cut too.
And the minister from UAE just joined us there too. Again, just since we have seen him pass by there, again, as you say, solid production there, a lot of investment and still going strong.
Still going very strong. But, if you're the UAE, if you're Saudi Arabia, what you're saying is if we cut and then the rest doesn't cut, then we are actually cheating our own population out of revenue.
Thank you for sort of hopping around the world with me this morning here in terms of what's going on in different markets. And this is something that we'll be continuing to do. The Saudi minister should be joining us pretty soon. But we're looking at various different regions. Let's come back to the non-OPEC. We've had a quick look at Russia, but then the other countries outside of that, South America, what's going on in Brazil and countries like that?
Yeah, Brazil is very challenging because, as you've seen, they had the PDVSA issues, and so it's a Petrobras issues. I'm in the wrong country here. Petrobras issues. So Brazil is challenging, and the very challenging thing for Brazil is the new fields are again ultra deep water, and ultra deep water is just very, very expensive. Now, another interesting country in Latin America is Mexico, because you've seen that Mexico has had great restructuring of the regulatory framework, and they've been doing quite well. And I think you will see quite a lot of investment going into Mexico.
And again, of course, it's got a big neighbour to America, a lot of production that'll probably come out of there. Let's hop over to Iraq. Now, again, there's a lot of issues there at the moment, and give us a feel for what you think is going on.
Well, it's a lot of issues, and as you know, Iraq has a lot of political issues. But what they also have is they have issues which is they have produced quite a lot, gone up a lot. Is it sustainable? My question is, how sustainable is the increase in production that they have miraculously performed over the last few years?
When we look on the longer term, I mean, right now we are in a very challenging situation, as you've said, but we have to look long term, and there will be growth in demand, coming on the market. So it's a real dilemma in a way because, as you said, it's a long-term business. They have to put that investment in, but right now it doesn't look like the best thing to do. So, what's prudent and perhaps, when they look long-term, I mean, what's probably better for the long-term growth and sustainability of the market?
I would have liked to say two things. If you have national oil companies like the UAE, like Saudi Arabia, like QP in Qatar, it's easier to put in the long-term investment because you can say, we're doing this for the good of the country and for the good of the population. Now, if you happen to be Exxon or a privately held company, then you account to your shareholders quarter by quarter. And if you invest in high oil in projects which need a high oil price, it will not be going down well with your investors, and your share price will go down, and you don't want that.
And again, a lot of the big players are, heavily invested in various countries around the world. I mean, so they're getting an impact, just not alone in the developing world, but also in emerging markets and in the developing world, so to speak.
Well, absolutely. They invested everywhere. And what the big companies also need, are the big super majors, what they need, and also other private sector investors, they need good regulatory frameworks, good investment regulation in the countries. Once they have that, they can invest. Before they have that, they can't do anything. And obviously, again, they need to justify every investment to their shareholder, who will scrutinize at what oil price are you investing for what production.
Let's take a look at the market in Saudi Arabia, and I do believe that the minister is actually just joining us now. We have a lot of activity, of course, going on here, a lot of interest in it. So talk to me about what's going on in the Saudi market.
Well, the Saudi market is very important. Is a very important market, and they have been staunchly investing in the industry despite of the low oil prices. And they have also, another thing is, they have taken quite good macroeconomic measures in their economy to talk in the oil market.
And the minister just went through there, of course, with the prince and his delegation here. They have a lot at stake, of course. I mean, they have huge economy. They've got, over the last few years, when we look at the social reforms that have been in Saudi and just the social programs, I mean, it's just huge. The country it's a big building site. They need that income really to move forward on all of the great plans.
Yes, and they have a lot of young people. They have a youth bulge, and they need to create jobs for all these talented young Saudi people. And therefore, it's a big building site. And therefore, they at some stage they would probably welcome a higher oil price. But at this point, it is about market share. It's again protecting the market share for Saudi Aramco, which has to deliver for the people.
Let's take a look at how the American market has been playing out, though. We have seen a decrease in the rig count, over the past year. So there are some signs that the higher price producers are actually coming off the market.
Yes, but one thing that's very interesting, we thought last year that they would come off very quickly because it's a fragmented, they're highly levered. But they haven't. They have actually increased their productivity within 5 years about 30%, and last year, month on month, about 3%. If you accumulate that, that's quite a lot. But we will see consolidation because they're so highly levered, and the banks have been going along with it for a certain degree. I think they've had it by now. So we will see consolidation, and then that shale scene will become very different. It will become less entrepreneurial and much more corporate. So it will become much more predictable than it has been up to now.
And again, it really is, a lot of those smaller players are very much dependent on, getting that funding from the banks and getting that support. But when they come off the market at this price, what is there to say they won't come back in if we do see a price increase down the road?
Yes, they will come back in, but again, you talked earlier about the talent. A lot of the talent they had has moved on, and they now probably do something else. Americans are very enterprising people. They don't have a job here, they go and learn other skills and they do something else. And then it will not be that easy. Again, it's not a light switch. That's not an ultra long cycle business, it's sort of medium cycle business, but it's medium cycle business does not equate a light switch.
Talk to me about the stocks in the US, because we're really seeing these stocks over the past year really, come to a point where they're at record levels at the moment here. Can they sustain that, and is that really where, the stockpiles, how good is that? What kind of an indicator of, what's going on in the market is that?
Yeah, if you look at OECD, we are right now, I think we have stocks for 60 or 70 days, which is incredibly long. But I don't think there's much more space to stock. We've now gone on floating storage, and there's not much more space to stock. And so at some stage, there will also some demand will go off because they won't stock anymore. But I do believe that we will see demand increase again, and then it will go out. And let's not forget, we're overproducing about 1 million barrels a day at this point. That's consumption that quickly comes up. So we shouldn't think it will go on for that. Once consumption comes up and you can't produce, we very quickly come into supply shortages.
And when we look at that, really, where are we looking? Where would you say later in 2016, or do we have to wait maybe for another year? Is the year ahead going to be as challenging as the year that we've just been through?
The first half of this year is going to be incredibly challenging, but I think with the middle towards the end, it will get better because again, also much demand and much supply has come off the market. And then 2017, I expect fasten your seatbelts. I really expect that we will see prices go up again, and maybe they will go up so quickly because so much investment hasn't happened that we will be very surprised.
And indeed, that is a danger too. That the prices then actually do go so quickly when it's almost like the market will be saying we didn't expect it.
Yeah, and it's that, and then it's also because we have all the derivatives, which amplify every movement. So when it goes downward, the derivatives amplify the downward movement. When it goes upward, the derivatives will amplify the upward movement. So yes, it will be. We will see lots of challenges in 2017, but they will be the inverse of the challenges we see now.
When you look at the economy, how hopeful are you that we're actually going to see a bit of an uptick in the economy? I mean, we haven't really seen the great demand come back on the market. There's probably everybody is cautiously optimistic, but caution probably the key word.
Yeah, I think the Mario Draghi's policy will help Europe. The Europeans will do well, and especially the European export industry will do extremely well because with such a cheap or undervalued euro, they can sort of go and export their products everywhere. The US will find it challenging if the dollar goes up. But again, the US is a very resilient economy. They will get there. And unemployment is only about 5%, which is very, very low. So they will do just fine. China will readjust to this more consumption-led economy. But there is a big thing in that as well, a big upside in that as well, because people who consume, they will buy lipstick, they will buy cars, they will buy all sorts of things. So it's not all doom and gloom. We have structural issues, but I think by sort of 2017, these structural issues will have worked themselves through the system.
And really, is it going to be, it'll be a consumer demand-led growth when it happens. It really is about getting the confidence back to the consumer to put some life back into the economy.
Yeah, absolutely. It's a consumer, and that's why Mario Draghi says, given all the things going on, especially on the southern rim of Europe, I need to do something to give confidence to consumers, because if nobody consumes, nobody buys, and that's not good for the economy.
And it ultimately does come down to that. So in a way, these lower oil prices, do you think that they've actually helped the consumption in a way and maybe helped to bring a bit of life back into manufacturing and industry as well?
Oh, absolutely. And I've done with my company, in my own model, I've come up that it equated the stimulus of about $2 trillion over the last 1.5 years. So yes, it has done quite a bit. And especially in America, look at the driving season. Look at the driving season this year. It was very, very active. So yes, absolutely, it has been a stimulus. And you will see when the oil prices go up, the OECD countries will say, oh, the oil producers are killing our economies. So we will go back to the same. We will go back to the same debate that we are all so used to.
And again, you sometimes wonder, is this, it does come sort of quite cyclical, and we could sort of pick up some of the old recordings we've probably done and roll them out here. But, the industry, surely, what are the lessons that they can learn along the way here?
Well, the lessons they should have learned is keep on investing, and I'm not sure they have learned it. And there's one sector we haven't looked at so far, which is the oil field service sector. And frankly, that's the sector that worries me the most. If you see, Schlumberger has fired as many as 10,000 people. And when you see the Schlumbergers of this world, they'll be fine, the Schlumbergers and the Halliburtons. But the smaller oil field service people, they have started to cannibalize their equipment. So, if something needs fixing, let's something from a rig that is not in use. And then when we need the oil field service industry, there will be a lot of equipment will not be able to be deployed because it's been cannibalized.
Do you also think in the oilfield services industry there's also the danger, well, not perhaps the danger, but just the realism, I suppose, of, we're going to see a lot of M&A activity here, and they're looking at it. But let's talk about Iran.
Well, Iran is very interesting because we will see once the sanctions are lifted, the thing will be how quickly can they ramp up production. I'm not as optimistic as most people are. Because people say, we have, if they have 4 million barrels on floating storage, if they release that by 500,000 barrels a day for sort of a month or so, $500,000 a month, then we have 8 months. And after that, they will need to invest to produce more. And again, as we said before, 25% of your production base going up is not an easy thing to do.
Cornelia, thank you so much, and thank you for bringing us on that round-the-world trip of what's going on in the market. I really, really appreciate it. We'll talk to you again. Thank you. And there we talked to Cornelia Meyer, really taking an in-depth look, and really she did a fabulous job.